Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
All right, welcome back to the About podcast. This is Jeremy Scott, one of your hosts here, joined ably, of course, by my co-host, Roy Hucke. Just you and I today.
Just you and I, buddy.
Yeah, which I think is fine. I do like our guests.
You know, it's nice to have guests, and it's kind of nice to digest some of that stuff the guests have said.
Yes. So that's why I'm looking forward to this idea today. So we're going to do a little Q&A, and we've got a list of questions that have come up, maybe some from some of the guests we've had or some of the other podcasts that we've done together, and we're definitely not going to get through all 25 of these questions.
We may not. I mean, maybe one word answer, but don't do it.
But I'm gonna pull some of these off, and I promise you, I'm not playing Stump Roy. Right.
No, you may.
I may.
I am a professional. I am credentialed.
You are.
And my name is Credentialed Wealth, but credentialed meaning I'm a lifelong learner. I don't know everything, so
right.
It's good to be challenged and continue to press yourself to learn more.
I get this a lot, weirdly, in my work too. People come up to me and ask me random questions, especially about the Bible. Like, I was reading this one passage, and I'm like, great. Like, yeah, I know how to figure that out with you.
Could you interpret Revelation for me?
Right. I know how to help you figure that out together. That's what I know. Do I have an immediate answer for you on every esoteric question about the Bible? No, I do not.
Yeah. If you can't quote it verse and
chapter and verse,
that's what I'm trying to say.
Yeah, I had a friend of mine once.
Can you do a chapter and verse battle?
Yeah, no, I would stink at that. I was just
that's probably a good thing.
No. I had one of my early pastoral mentors was like, I cannot quote you chapter and verse, but I can probably get you in the neighborhood. Like that sounds like Isaiah.
I have a good friend who's a Lutheran pastor, and that's kind of where he was at. He's like, we're not using the word to beat you over the head.
Right. Well, the famous quote I think from Einstein that may or may not be true is somebody asked him what the speed of light was, and he says, I don't know, I can look it up. And I'm like, and with Google, like, I can find whatever you want to know. I can find you in about 30 seconds on Google.
It is quite interesting because, the expertness that you have in life, being you a pastor or me a financial planner, you have AI now. And AI can answer a lot of these questions. If a client goes to an AI tool and says, well, whatever the question is,
right,
it'll give them an answer. Now, was it actually accurate? We're not sure.
Right.
I mean, as a professional, I would know in my area if it's right or not. Right. But as the client does that, are they confident it's accurate? And the answer may be no. But still, it gives you a starting point.
Right. So I've been using a lot of AI in work.
I've noticed. I'm joking.
Have you? I was like, I'd be interested if you did. And there's probably an episode in there too. So about AI.
Yeah, absolutely. I think so too. Well, it's like, if you're writing something, a summation, right? Let's just say you have notes and you have a summation of your notes, but you want to kind of put it into a format that can be read. Mm-hmm. Well, you could just load it into the AI and then it spits out everything kind of concise and clear in a written format if you want it to. Or it can take that written format and turn it into a bullet point type setup.
Right. I have heard because I've written a couple books, nothing exciting, self-published, but they were all right. And I've talked to other people who've written books or longer form stuff or whatever it is, and they always talk about the crappy first draft. You got to get the crappy first draft out. And the thing that I've learned about AI is it is really good at helping you get that crappy first draft done. And then
tweak it.
I put out some stuff that, started with, an AI thing and then became, then by the time it was done, the version that was released or put out in the world probably wasn't, it was recognizable as something that started with that, but it was just nice to not have a blank piece of paper to start with and go, I want to change this, tweak that. So
yeah.
Right. Well, this is not the episode about AI.
No, but, it's one of those things where it's definitely a tool that exists out there. And I think we need to make sure people are aware of it, know how to use it, and then help them become maybe a little bit more informed about something, but then go actually seek out experts to help kind of hone that. Right. Get that first draft of information that you're going to go talk to somebody about kind of in your head, and then go actually hone that actual information. So we're trying to hone some information for you today.
We are honing some information. Well, what's the famous Reagan quote? Trust but verify.
Yeah.
When he was dealing with the Russians, it's like, trust but verify.
Well,
so I think if you can get some answers from AI, which is great, but verify.
I use the trust but verify because I have a lot of clients say to me, he's like, well, Roy, I trust you. I say, I understand that and I really appreciate that, but I want to make sure I'm giving you the verification so that if Roy's hit by a bus, you know exactly what's going on and why.
Right. Exactly.
And that trust but verify is really important.
All right. And if folks hear a little laughter in the background, it's because on the other side of the wall that we're recording on is about 30 ladies having a ladies' Bible or a church ladies meeting and having a party for.
Yeah, they kind of heckled me when I came in here.
Yeah, they do that. They're a feisty bunch. All right, so the first question that only because I just went through this with you, that I want to talk to you about is, and I'm not sure when this is going to release, but I think most of us have been in that situation where, maybe we got a bonus or maybe we found ourselves with a little extra cash for whatever reason. The question becomes, do I pay off maybe some debt that I have versus, do I add this to my investments or do I use this to start investments? And so is there a quick rule of thumb, just like a triage kind of thing that you may say, definitely pay the debt off if it's this, or definitely do the investing if it's that?
Well, what's interesting is when people ask me that question, I always kind of dig more and I'm like, okay, maybe one or the other, maybe neither. So I usually start with, okay, you have debt and you want to save for your future, right? That's where we're at right now. And then I'll ask them, okay, how much do you have in your emergency fund?
Yeah.
And the answer is typically, well, we have debt.
Right.
There is no emergency fund.
There is no emergency
right?
fund.
That's the situation that's going on right now. So typically what I'll help people do is kind of like, how do we balance that?
Right.
So the first thing you do is look at the debt and the type of debt, and you kind of like break it down to what's my highest interest debt to my lowest interest debt.
Right.
Right. And what's the design of that, right? Is my lowest debt my home at a 2.5% interest rate that I refinanced 3 years ago in COVID?
Right.
And that's my biggest debt amount owed, but lowest interest rate.
Right.
Right. And then how do I determine where does that fall and how I pay off things? Because I want to have my home paid off, right?
Yeah, absolutely.
That's what people say to me all the time. But then they also have credit card debt, maybe some student loan debt, right? Maybe a car debt. And all that stuff you have to take into consideration. What's the duration of the debt? What's the interest rate of the debt? But for simplicity's sake, you typically look at what your highest interest rate is.
Okay.
So, and then rank them like that. And then on your lowest rate, you pay the minimum interest owed. Well, payment, I should say, not necessarily interest owed. But the minimum payment and then extra monies that you have, you put towards that highest debt.
Right.
Now, the question comes down to is how much am I paying in interest if I just maybe only pay some towards that, but then also some towards my retirement?
Right.
Right. And that's the concept we're talking about, trying to figure out. And it depends. How much, right? How much debt are we talking about is really the starting point. And then what I actually tell people is, do you have an emergency reserve? And if you don't, okay, we need to not invest right now. Right. We need to maybe pay off debt and add towards our emergency reserve.
Right.
Or some of my clients will have like a home equity line of credit, a HELOC for short, which is just a line of credit on your home.
Right.
And we have that as a worst case fallback if like something really bad happens, but every other dime is going towards paying off that highest interest debt.
Right.
So that we can get that high interest off of us.
Oh, so the HELOC at that point is acting as the emergency reserve.
Which is not ideal.
No.
But it's a short-term fix. Right. Because if you really hammer at that debt, you can really knock out a lot of debt first. And it's called a debt snowball, right? Because then what you do is you pay off that highest one and then you roll everything onto the next highest one, right? And then the next one and the next one. And you can really pay off debt really quickly that way.
Yeah, yeah. I have found sometimes like just emotionally it's satisfying, especially if you have smaller debts. If you can sneak one in there, even if it's not the highest interest rate, but you can sneak one in there, you just pay it off. You're just like, oh, great. I never have to hear from that company again.
Yeah, and that's a very valid thing.
Sometimes it's nice to be able to remove the line from the spreadsheet, even if it wasn't the highest interest. But if you've got, lots of high interest debt and, maybe a couple smaller things, I just find like emotionally satisfying and feeling that sense of accomplishment that is sometimes motivating to keep going.
And I'm unemotional about your money, so I don't care.
Yeah. Yeah.
Right.
But I'm very emotional about my money.
But I honestly get the fact that I just want to have something to say I had a win.
Right.
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 And I can feel good about it. And that's totally okay.
Yeah. Yeah.
That's
I want
totally
something in the win column. So,
but I'll still do the math for you and be like, well,
Yeah. Well, and I'm sure the equation was different when, savings rates were, are, you know, at 0.01%, you know, or something like that too. You know, so we talked about this in the other podcast where this came up in our lives was around the timeshare that my wife brought into our marriage. And what do we do with that? You know, paying that off versus, you know, doing something else with that money. But that interest rate was high enough that I'm like, I think I'm just going to pay it off. And then we did. And then I basically set it up where I'm now the money that was going in the budget for the timeshare is now going back to my money market account with you. You know, and I'm basically paying myself back. Yep. So that's the other option, I think, too, is like, you know, and that's what an emergency fund or, you know, savings lets you do is, you know, you're borrowing from yourself and then you're paying yourself back. And I would much rather pay me back than, you know, random, you know,
so that's
timeshare at 18% or whatever it was.
It's a great example, though, because I'll ask that question about emergency reserve, because if they have an emergency reserve and they're paying a huge amount of debt, I might still tell them because you're getting 4-ish%. Well, it depends. If they're just in the bank, they're getting a really low rate.
Oh yeah, you're still not getting great.
But if they're in a money market, they're at least getting probably 4-ish%, something in that range today, right? And I still might tell them like, pay that off right now, and then pay yourself back,
right?
Just like you explained, and that's a really good way to do it too. But that's why I usually start with: do I save for retirement? Do I pay off debt? It depends. And it really depends on the emergency reserves on how we attack that.
Right. So if you're not in a situation where you've got the, you know, maybe you've got a manageable amount of debt, maybe it's just your home, it's at low interest. The other thing about home is there's tax advantages to mortgages that there aren't to like car payments and stuff like that. So, you know, and all of that. But, you know, so if you're in a situation like, okay, I don't have any extremely high interest debt or anything like that, and I want to start investing. I'm in a place where I feel like I can do that. Maybe got a little reserve, you know, built up, you know, or whatever. But if I've never invested before, like if I've never done that outside of, you know, just, you know, putting stuff in my 401k, you know, that's most people's experience of investing. Like, where do you start? Like if I want to start, say, okay, I've got some money. I want that money out there working for me. You know, as we talk about, right? You have money working for you. Where do you start? Like, what's the starting place for investing if you are starting from nothing more than probably, you know, basic retirement?
So let's assume that your debt and your emergency reserve are in good condition in this conversation.
Yeah.
Okay.
That in this hypothetical, that is true.
Okay. So then from there we start with, okay, what are we trying to do, and you know, where are we trying to go, and what's our free cash flow? Right. A good starting point or rule of thumb is to think if I can save 10% of my income, that's a really good kind of goal. Right. That's just kind of a rule of thumb. Right.
Right.
And then from there, it really depends on, well, you know, if you make a really good income, you might want to have a lifestyle that continues in a certain way. So we have to take that into account.
Okay.
So somebody that is potentially approaching me is what I'm kind of presenting to you, right?
Right.
So when I'm looking at the situation, it's okay, how much free cash flow do we have? What's our lifestyle, right? What's our goals? When do we want to retire? So what's the time frame that we're looking at?
Right.
And that kind of all determines, you know, how much we need to start saving. Also depends on if they have any kind of pension involved, which most people that are younger today don't have that, but I do have a lot of government employees that still potentially have pensions.
Sure. It's weird that I have some.
Yeah.
You know, but ours is going away though next year.
Yep. And that's kind of the way of the world right now, is pensions are going away because it's a unfunded liability a lot of times for the institution that's behind it.
Right.
So anyways, you take all of their sources in. If it's, and this is maybe right or wrong, it's no real proper way to do it, but like if Social Security, if you're under 50, I'm not even really looking at it, because right now in 2030, I think it's 2033 or 2034, they might have pushed it to, the Social Security trust is going to go broke.
Right.
Which just means there's no money in the trust fund, and the money coming in from current workers is less than what retired workers need.
Right.
Based off the calculations that they should be getting.
Right.
Okay. So you could have potential people getting 70 cents on the dollar, 50 cents on the dollar, 30 cents on the dollar, depending on how they do it. But I think they'll probably square that away for the older generations, but younger generations might, you know, not be able to file for it until they're 72.
I fully expect that if I know who's kind of getting screwed in that scenario.
Yep.
And
younger folks, but I also think younger folks are kind of being trained to say, "Hey, I need to save more for my own retirement."
Well, that's the thing. I mean, if you're paying it all attention, because I know I think when we did my calculations, I'm like, don't even. That would be a nice little bonus.
Yeah, that's icing on the cake if it's there.
Yeah.
Cherry on the top, whatever. Yeah. But we just don't depend on it because we don't know what's going to happen because they haven't fixed it. But we do know right now that it won't be fully funded in 23 if they don't do anything. 2033. Right. And do you think anybody right now in the political environment we're in is going to expend political capital on fixing that when it's 10 years out?
No.
Not a chance. Nope. They'll fix it the year before probably or the year of.
Yeah.
And that's how they do things. And anyway, so not to go down that rabbit hole, but we look at all those things. What are our income sources? Do I have rental income? I have a lot of clients that have, potential income coming in from that.
Yeah.
So we take into consideration all those things. And then we look at the assets that you're saving in a retirement account. Or I always tell people it's kind of like your liquid assets, right? Mm-hmm. So we can actually take and spend that how we want, when we want. There are potential tax consequences. So I do talk about income tax diversification, which is, am I saving an account that's going to grow tax-free for me and I can pull it out tax-free? Is it tax-deferred and I'm going to pay taxes later?
Right.
Is it taxable, pay-as-you-go, right? So you're talking about a single account or a brokerage account that's not a retirement account, pay-as-you-go. A traditional 401k IRA, pay income tax later. Mm-hmm. And then a tax-free account being a Roth type setup with a Roth 401k or a Roth IRA.
Right.
And, we look at that income tax diversification because if I need $100,000 of income in the future, well, if I put money into my Roth today, it's going to grow tax-free, but what rate am I paying on that versus if I put money in my traditional account?
Right.
I'm going to defer the tax to the future, so it gives me some benefit today, but if I defer all of it to the future, then I could have a really big number and and then it's all income in the future. So if I have like a mixture of all of them, it gives me the most income tax diversification. That in some years, if I have really low income, I want to take a lot of money out of a traditional 401k account.
Right.
Or if I have a year where I have a lot of income for some reason, I need some more, I could take it out of a Roth type of an account.
Yeah.
Or if I don't want to deal with either of those, and I have a brokerage account that I can just take it out of. Or like I have some clients that retire pre 59 and a half, which is when you can get into a retirement account. There's some nuances when you can do it before, but I'm not going to get into that.
Yeah.
But let's just say that that's the case. And, you need to have the ability to bridge the gap.
Right.
So I look at all of that. Like, what's the lifestyle? What's the savings? What's the cash flow? What's the type of income tax situation you're in? And that's why the planning piece of what I do, my industry used to just be like, well, I just invest money.
Right.
But I went the planning route because how do I invest money if I don't know how it's going to impact you in the future?
So I would talk about this a lot on this podcast, the need for a plan, right? And so I think when it says, how do I get started with investing? I think, if you find yourself in a position where you've got that opportunity to do some investing with some free cash or whatever that you might have, well, then that means you also have the opportunity to start, really start looking at planning. In fact, you probably already should have been, but I mean, that is an extra impetus to say, okay, well, where does this fit into my plan? And do I have one? And if I don't, then how do I get one?
Yep.
Like, how do I find somebody or work with somebody? What I'm not hearing is start an online account and start day trading.
No.
I probably not.
You could, but I don't advise it.
FanDuel? How you feeling about FanDuel?
No.
Yeah, sports betting? Is that a good investment
we're
strategy?
Methodist, right? The Book of Discipline has a real thing against
it does.
gambling.
Yeah. Unless you are the owner of the casino. Casinos are bad investment strategies.
Right. Well, so anyway, so that's what I would end up doing is just looking at the whole picture and figuring out what makes the most sense for how they're trying to live their life into the future. And I always tell people, tell me the future and I'll tell you what to do exactly, right?
Right.
We just try to make the best educational decisions we can at that point in time. And my job is to make sure you understand the full picture to be able to make an educated decision. Mm-hmm. And not just tell you what to do, even though some people I just need to just tell me what to do.
Right.
And I'll be like, well, here's what I think you should do, and here's why, but I want you to make sure you understand that this exists, and this exists,
right.
and here's why I think it makes the most sense, but I just want you to understand why I think it makes the most sense so that you can't come back to me later and be like, well, you told me to do this, and this didn't make any sense. So I educate people first, and then, of course, if you need a recommendation, I'll say, well, here's what I think makes sense, and here's why. But I just want to make sure you understand the whole picture, and then you get behind that decision.
Right. So one thing that we haven't talked about a lot outside of some specifics is insurance. And so we have a question on our list about, insurance and what do we really need when it comes to insurance. And I will tell you, I will own my biases to say that I am a kind of a just the essentials kind of guy when it comes to insurance. And I know there's different schools of thought and different people have some thoughts about it, but and I got a couple stories about that, but I'll wait. But I have never in my life bought an extended warranty on anything, and I've only ever once had a situation where it might have helped me, and what I saved in never buying them was way more than what it cost just to replace the thing that I bought. So now, if you're an extended warranty person, okay, I guess there's a place for it. But I think of those as like a form of insurance, right? I mean, that's what they're trying to say. So I'm gonna name my biases from the beginning, and you're always welcome to disabuse me of my biases, Roy, when it comes to this stuff.
I'm a little disappointed right now, Jeremy.
Okay.
Because we have talked about the what ifs.
Yes.
What if I lose my job?
Job.
What if I lose my health? What if I lose my life?
Yes.
We have talked about insurance.
We have talked about insurance. You're right. We have.
So that comes into play. So that specifically is emergency reserve. What if I lose my job?
Right.
Right. What if I lose my health, being disability insurance, health insurance, right?
Right.
All of those pieces of the puzzle for the health purpose.
Mm-hmm.
And then the life insurance if you lose your life.
Right.
Right. So now beyond that, there's other insurances to consider. Well, one you have to have if you own a home.
Right. And I think when I was looking at this question, I was thinking more like the home and auto. I don't think we've really talked about that.
No, we have not. You're required to have the home insurance, right? If you have a home. And the question is, how much coverage should you have?
Yes. And
a lot of times people forget, right? You just bought a home for $500,000, person X, right? And
hey, how'd you know?
How did that house actually get, what was the cost of the actual home to build? Right. So you have the lot, you have the water tap, you have the utilities that came in, and then you have the structure, right? So if you're replacing a home, typically you're replacing the structure. Yes. So that's what we're trying to insure. Right. Yeah. So do I need $500,000 of insurance if my home purchase was $500,000? Well, maybe not. Maybe you just need the amount of the structure. Well, what kind of structure is it versus what kind of land is it? Are you sitting on 50 acres and a small little house, or are you sitting on a little lot that's a big old house? Right. Oh, yeah. So taking that into consideration, I work with a broker myself because this year I had a 54% increase on my insurance premium. Ooh. And I was like, what do we need to do to not have that? Right. So anyway, working with a broker allows you, and when I say broker, I just want to be clear for people, that just means they have multiple companies they represent. Oh, okay. So captive agents are someone like State Farm. Right. Or Farmers Insurance. And that's the only option that they have. Yeah. So a broker can go out there and kind of broker the deal for you, essentially, right? So there's sometimes pros and cons to both of those options, being a captive or a broker. Okay. But that's the starting point, is like, how much coverage do I actually need? What are the risks around me? Right? Do I need to have flood insurance? Yeah. Is part of that. They say I'm not in a floodplain, that I am on the bottom side of a hill. And do I maybe need to consider some? What if you're on the edge of a canal of water? Right. Which we've had here in this town recently, where there was an issue with that. Yep. We have. Then those things need to be taken into consideration, right? And again, you can't be perfect, but you just need to think through that. Right. And what's the actual replacement cost of your home? Because 5 years ago, my home was valued at $500,000. Today, it's worth $650,000. Right. Well, some of that's growth from the land, some of that's growth from the structure. So the same policy you had 5 years ago isn't adequate for 5 years into the future. Right. So we need to beef up that coverage maybe a little bit more than we had. And how many people actually have a conversation with their insurance person every year, or they just pay the new premium? Right. Oh, yeah. And some policies do have built-ins for that, but you just have to be aware of it. So like with me with planning, I don't sell car insurance or home insurance or that stuff. I do life insurance and long-term care insurance, right, disability insurance, those kinds of things. But those other pieces, you need to have a professional that knows what they're doing and can talk with you about your situation and advise you and let you get educated on it, make a decision that's best for you. Yeah. So let me, because I like to do this, put you on the spot a little bit. Sure. So I'm going to tell you what I did, and you tell me if I was dumb. Uh-oh. So we just bought a home. I have not owned a home previously to this, because I lived in the Parsonage's church. Ever? No, I have owned. Oh, okay. Yeah, but not in Colorado. Okay.
But it's been several years. So I didn't have any existing relationships with a home insurance company here in Colorado. So I had to go find one. And when I eventually, worked with somebody and kind of got it down to two options, and it was all about the roof, because in this part of the world, the roof is a big deal. The wind and hail and all that kind of stuff. And our house is only 20 years old, which is great, but the roof is original. And so, you basically came down to a choice of, you can pay a higher premium that will cover full replacement value of the roof, or you can pay a lower premium that gives you cash value for the roof, which is to say not much once you've reached that. Apparently right now, what I was kind of been told is if your roof is over 15 years old in Colorado, insurance companies are getting really kind of weird about it, because we just had so many hail incidents and roof incidents about it and all that kind of stuff. And I went and did the math on it, and I'm like, the difference in the premium over 3 years pays for a roof.
Really?
Yeah, it was that much.
Wow.
It was that much difference, maybe 3.5 years.
Wow.
But the difference was that dramatic, as you were almost there. And I was just like, so then he's like, well, what is the chances that I'm going to need one in 3 years? And so, so I feel like with insurance, you end up ending up with that math. And I've had the same situation on my car insurance where, like, especially around like deductibles, it's like, well, you can have a $500 deductible or $1,000 deductible, but the $500 deductible costs an extra $300 a year. And I'm like, am I going to have an auto accident every year? And with $1,000, I mean, you're just like, I find, and maybe it's just the engineer in me, I do that math where I'm just like, I would rather take the higher deductible, put more in my emergency fund, so that if I do have, a claim, I've got the deductible on hand, and assume that I'm not going to have 3 claims in a year, right? Because that's where that would help you out, if you have 3 claims in a year, like, okay, but if I have 3 claims in a year, my auto insurance company's probably dropping me anyway.
Yeah, that's very true.
So I guess the question is, do you think it's worthwhile to like do that kind of math, or do you think there's like a rule of thumb around this that we should be following, or?
It's always one of those things where you look at the cost benefit, and if you're paying for the roof and premium difference in 3 years, that's a really short window.
Yeah.
Right. Now the reality is, could you need a roof this year, and could you need a roof next year? Yeah, technically.
Yeah.
I know people that have had that situation happen.
Yeah.
So you're rolling the dice kind of one way or another, right? Yeah. But if you have an emergency reserve that's proper, that can cover that cost for you, and now you have a cash flow savings per year because of it, well, the odds are you're not going to need a new roof every 2 years. Maybe you hit a patch where you do. Right. Right. But if you're paying that extra premium, you don't need a roof for 10 years. Right. Well, now you just paid for like 3 roofs.
Well, and of course, there's a little bit of like, well, I mean, that it can happen where you're like, okay, we just put a roof on, and then 2 years later, another hailstorm comes through and takes it out again. Yeah. So it's not unheard of by any means, and that's kind of worst case scenario, in a lot of ways. And it's not that it's never happened, but it doesn't happen all the time. And so, like with that one, I'm literally looking at these because I'm literally betting on the weather right now.
Welcome to farming.
Right. And I'm just like, man. And it's like, what do I think is going to happen? Like, I have.
Hey, don't you have a direct line to the act of God fella?
Yeah, well, yeah. He doesn't call me. He doesn't. I don't get tipped on.
He doesn't give you the run by?
No.
Darn it.
So I feel like that's like, for me, like that's the situation I find myself in a lot in, like, especially like homeowners insurance and car insurance and those kind of insurance products, is there's so many options now, so many different deductibles and maximum kind of benefits and coverages, and so it's you can lose yourself down the rabbit hole a little bit.
You really need an honest professional that you can feel like is truly giving you good advice. Right. And, that's not easy, honestly, to always feel like someone's giving you the good advice, or they're just giving you the advice of the product that's going to pay them the most.
Right.
But a lot of times it comes down to that, getting educated about the options, because I saw one recently where they have a deductible that is a percentage of the house value.
Yeah.
So those deductibles are getting much higher anyway,
yeah.
Right? In your situation, yours is a little bit different in that regard. But I always tell people, it's kind of like what helps you sleep the best at night. Right. I have some older clients like, boy, I'd rather just have it covered if I needed it, and I can pay it with my cash flow. Yeah. And they're fine with that. Yeah. And I have some people are like, well, why would I pay that when I could just save that? Right. and they do that. So it honestly, same thing. It kind of depends on just how you feel about it and what makes you sleep well at night.
And for me, where I came down is like, I do that. If you actually do the saving piece of it. Right. But that's where the self-discipline
that
comes
is in. If, right? Because I know a lot of people that will use a tax return as a savings tool.
Right. So you actually have to do, you're like, okay, I'm going to take the risk of the higher deductible or whatever, and then that's going to make my premiums, X cheaper. But then you kind of have to, you do kind of need to take at least some portion of that difference and save it.
Yep.
Right.
And at least until you get at least one roof replacement, right?
Right. Yeah, until you've got enough saved up that you can you can do it with minimal.
Yep.
And I think that's the piece that you can get.
So if you know yourself and you know you're not going to do that, you pay the higher premium.
Right.
If you're disciplined and are willing to do that, then the other option might be a good option for you.
Right. Right. Well, because in a weird sort of way, it feels like in places like here in Colorado, where we have such an active wind and hail thing. It's like homeowners insurance is almost like a roof savings account. It's kind of how it's treated. I know for some people they're like, well, just hope for a hailstorm and they'll replace your roof, and I'm like, well, maybe not.
Yeah. Well, it'd be nice if we had better products that didn't have to worry about it, right?
That would be great. So
what's up next?
All right. So, for something completely different, credit score. 1, how much does it really matter? And 2, how do we make it better?
Oh, it matters.
Okay. I suspected as much.
It is the biased opinion of me that it's one of the biggest scams out there, but it is a process that we have to play by.
Are you calling out TransUnion or whoever it is? I don't know who.
There's 3 of them, right?
Yeah.
So the credit score is an important thing, right? Because the concept is this: if you want to borrow money, you have good credit, then you pay less interest rate to borrow the money. Right? Lower credit, you pay more interest rate to borrow the money. So you want to make sure that you try and have good credit. And how do you make bad credit good credit? Is by paying your bills on time. Right. Actually using your credit is actually one of the tools. If you don't use it at all, you're actually technically not improving it.
Right.
And I just don't like the whole process because I feel like it's forcing you into a debt situation to be able to build credit when you don't necessarily need that. Now, the reason I say that is because we'll use your credit card. Okay, great. And then there's that 1 month where you overused it. Right. And now you're paying an interest that's 20%.
Right.
And you're now, you're getting behind. So I don't like that concept because that's the easy route to build credit is to use your credit like a credit card. But that's the design of it, right? Yeah. So, but paying your bills on time, if you do have a loan, right? Don't miss payments because that'll definitely hurt you. And that's one of the best ways to do it. And have low debt if you can. Right. But it's funny because if you have no debt, not good for your credit.
No, I read a situation about a year ago where it happened to be this little place in my life where pretty much everything was paid off and all that other stuff, and I can buy things with cash. So I wasn't really using my card all that much, and I got a little alert that said, "Hey, your credit went down." My credit score went down. I'm like, "How did my credit score go down?" I'm like, "What?" Yep. And then I and then it immediately went back up when I co-signed on my son's car loan.
But fiscally, don't you think you're making good decisions by not having interest or having a debt payment, right?
Right.
You are, and you're being penalized for it. That's why I just don't like it.
Right. Well, and that's one of the things I feel like, especially when things like around credit cards, but credit in general, we are often find ourselves incentivized to do the wrong thing.
You are.
Right. Because honestly, even when I can, just pay cash for everything because I've got it, like I am reminded, like at Costco, like, oh, but I'll get 4% back if I put it on my card. And I pay it off at the end of every month.
And then you bought that, 55-gallon drum of pickles you didn't need.
Right. And then, and then, but you're right. But then you run into times like now, like it's Christmas. We got 4 kids to, figure out and everything.
People get themselves into a little bit of a bind sometimes because they're like, well, I can just put on my credit card and I'll pay it off later. And well, what's a little bit of interest if I can, the kids can celebrate. That's what happens. And it pulls on people's emotions, and it's just not a good way to have things go. And I really would like to be incentivized to make good fiscal decisions and have low debt. Right. And the best thing would be to, like we kind of talked about earlier, is like if you can use yourself as the bank, like we talked about using that emergency reserve, paying off the debt.
Right.
and then paying yourself back, you're using yourself as the bank in that situation.
Can we find a way that I can give myself Hilton points for borrowing from myself? So I don't have to use my Hilton Amex for it?
Hilton will not make billions of dollars with you doing that.
Darn it. That's right. Darn. But that would be interesting. Okay.
Yeah. So that's the, there's a lot more that can go into credit. And if somebody's really in a bad pickle, there are specialists out there that will help you get out of that.
Yeah.
And there's processes you can go through, especially if you've had a bankruptcy or something like that. But in general, do the fiscal responsible things and you're going to have good credit, but you do get penalized for being really fiscal responsible. Right?
Bankruptcy. That's another podcast for us.
Mm-hmm.
Yeah. So it is a tool. Kind of the nuclear option, but still an option. So, All right. So I think we can do one more question. I'm going to go dealer's choice on this one. Roy, is there one that I did not pick?
I don't have a specific
that you're like, why didn't you ask me about that one? Are you really excited to talk about?
Well, here's a really interesting, and actually I'm seeing this question on here. I just met with a young man.
Okay.
And he's getting married. Awesome. Congratulations.
Good for him.
And you as a pastor can probably relate to this, right? So here's the question. It says, what financial red flag should I watch for in a relationship?
Okay, this is a good one. I ask in my premarital counseling, we spend time, there's 3 things we have to talk about as part of my premarital counseling if I'm going to marry somebody, is we got to talk about kids, we got to talk about sex, and we got to talk about money.
Rock and roll, baby.
And then if you haven't had conversations and have some mutual understanding of each other's desires in those 3 areas, then there will be problems, because that's what breaks up relationships, is those 3 things. And I found it's not that a saver can't be married to a spender, if that's those categories, even a little broad, but it's that you have to understand each other and respect where each other is coming from and how are you going to work through it, right? And so now if one party wants 0 kids and the other one wants 10, then that may so problem. But I think this is a good one. And the one that the thing that when I ask about it, that people are always surprised I ask about is the money. When we have a conversation about the money, they kind of expect we're going to talk about kids. Maybe they think we're going to talk about sex. But when I start talking about their money, they're like, what? Why do you want to know? And I'm like, no, I want to make sure you know.
Yep. Well, so I was really excited for this young man. He's a really good kid, and his parents I've worked with for years, and it's really cool to see habits that the parents have, go to the child. Well, I did ask him, hey, what are you, I actually said, are you going to do any kind of premarital counseling and kind of see, where you guys both stand on some things? And he's like, no, I hadn't thought about it. And I said, I really, really encourage you, before you go down that road, to talk about the financial piece of your life, the child piece of your life, which is funny that I just said the same thing that you just said, right? And then the sexual piece of your life.
Intimacy, if you will.
Right. So that was one of the things that I really encouraged him to do. And I'm not sure if he'll do it or not, but I can't lead the horse. I can only lead him to water, right? But those pieces of the puzzle are really, really important. So the specific piece to relate to me is the financial, right? And debt is number 1. You have to be crystal clear where everyone's at on debt in the relationship, right? And you have to be crystal clear on how they do spend, right? Because if it's somebody that's like, well, money's in the account so I can spend it. Or is it somebody like, I need to have a budget to know where I'm at and how much I'm allowed to spend, because I need to have, some of this other money over here to pay the mortgage.
Right.
So those are really, really important pieces of just understanding. And the respect piece that you mentioned is spenders and savers. It is hard. It's not impossible.
Right.
But you got to respect the other person to know, like, well, I'm a spender, but I also know that here's the line.
Right.
And I can't cross that line, and I'm willing to not cross that line because I respect my spouse enough to not cross that line. Right. Not saying anyone's perfect, but that's really important to have that conversation, flush it out, at least know what you're getting into, right? And know that, hey, everybody tells me I'm single, but everybody tells me that relationships are hard.
Yeah. They are. Well, and I, and we've talked, I just got married, back in, well, it depends when this drops, how long ago it was, but we're both, middle-aged. We both have established lives. And I remember when we sat down and said, okay, I'm like, basically, I'll show you my spreadsheet if you'll show me yours. And, and I showed her my spreadsheet that had my budgets and my assets and my debts and everything laid out. And I'm like, this is where I'm at. And then, and so she did the same thing. And then we kind of like, okay, like we started to put them together. And so when we started to have the conversations about, if we were to combine households, where would we live and all that kind of stuff. But that helped. It didn't dictate it. But it definitely helped when we could sit there and say, okay, like here's realistically what we could afford and all that. And it was a very vulnerable moment. I mean, sharing that kind of information is a very vulnerable kind of experience.
You told me it's very vulnerable meeting with me, so
yes, it is. And so you're kind of exposed a little bit. And this is somebody, in the course of an intimate relationship, is somebody that you care about and you want them to care about you, and you want them to think good of you and all that kind of stuff. So it can be that way, but you have to have the conversation.
You've got to be honest about who you are too, right? Don't hide things.
Yeah,
just be real, because you're getting married, and if they can't accept you at your worst now, they'll never accept you at your worst.
And I've had that exact conversation with couples where I'm just like, if you can't talk about this, trust me, there is way more things that are going to come up in your marriage that are going to feel uncomfortable in the moment to talk about that you have to talk about. So if you can't. So I find sometimes the challenge is, especially for people who, when they get married younger and they don't have a lot of financial history and they don't, they
know how to deal with money, and
they don't know how to deal with money, and they're equally ignorant in it. Then it's like, okay, find yourself a Roy, like get somebody to talk to and all that. But
those are my most fun clients too, by the way. I love those clients. They're like, we're together. We want to save on. We want to do this right.
So maybe to answer the question, maybe one of the biggest red flags is secrecy.
Yeah, if
they're not willing to be transparent about their financial situation,
it's a very red flag. Will you ever be able to make that truly work? I mean, maybe, but do you really want to? Is another question.
Yeah, and I know, especially like there are couples that maintain separate checking accounts, and and treat the household more like a roommate situation than anything else. Whatever works for you. I think I tell couples that all the time. Like, whatever works for you in that regard is fine, as long as you both understand and you both want to do it that way. I mean, you just need to come to some sort of shared understanding about it.
Yep.
So,
Yep. And be honest and truthful, and things are much more transparent in the light.
Yep.
And easier to discuss and understand people's points of view when it's fully out there, right?
Right. Absolutely. All right. So, well, I think this has been great.
I don't disagree.
I think so. Anytime I get together and chat with Roy, I think it's a good time. We've said on the podcast, we say after we quit recording all the time that, it's always such a good feeling when we're done, because it feels like we did something
fun,
helpful and useful.
Yeah, helpful and fun and invigorating.
Yes, and so
fills my cup.
It does. And of course, we only do that because you all watch or listen or however it is you're connecting with this. And it definitely helps our motivation to do it when we know there's an audience out there, and we definitely love to see it when the audience is growing. So if you have found this helpful, the best thing you can do is, share it with your friends, share it with your family. Even just a specific episode on a specific topic. I've done that a lot with podcasts, where I'm just like, maybe you're not interested in listening to the whole thing, but there's one that we did on a particular topic someone needs to hear. Share that with them. That is a really, really helpful thing for us. And then, of course, if you have questions, send them in. Our list we're working with is some that people sent in, a lot that Roy just runs into in his life, or things that I've run into. But we'd love to have your questions. We will eventually run out of things to talk about. I don't know. Maybe
I don't know. It's kind of ongoing, my friend.
It keeps changing.
There's so many. The rules are changing. We'll see what happens next year with some of the. Well, maybe the current
or later this year.
Depends on where we're putting this one. But there's laws that change all the time, so we just got to stay on top of it.
Yeah, absolutely. So, all right. Well, thank you, everyone, for joining us and being a part of it. And thank you, Roy, for hanging out.
Thank you, sir. See y'all later.
Absolutely.